Hello, everyone. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown with me, your hosts, and the author of the newsletter, Dr. Michael LoPiano. It's very good to see you. Today's topic, we are talking about what things are going to look like going into today's, that is Friday, December 13th, our trading day today. We're looking at something along the lines today of some market maker gamma exposure weakness. We have a high concentration of call gamma in particular that has built up around this $30 strike. It looks like market makers are stacking up potentially the ability to short a large volume of shares in anticipation of potential bullish attempts to exploit this high concentration of call gamma and the potential to send the price upward and above $30, which would result in something not particularly beneficial toward market maker profitability. So we're going to talk a little bit about this today in today's breakdown. If you are joining us perhaps for the first time, you can find my full article, my full day's write-up over on my Twitter page. If you're watching this on YouTube, it's down in the comments, linked. If you're watching this on X, it is up pinned to the top of my page, so go ahead and have a look there. Before we get started today, I also want to invite everyone to join me and your fellow GME investors. At the end of the trading day today, after market close, we will be having a weekly live stream question and answer session to kick off the weekend, to look back on this trading week, maybe think about some broader frame theories or ideas about what might be going down as we head into the end of the year and into next year with GME. So be sure to tune in at 4 p.m. Eastern time after market close. We'll get together, bring a beer if you like. We can do a little cheers in the spirit of everyone's favorite roaring kitty, certainly. So, okay, so let's hop into today's breakdown. So, yes, we are looking at potential market maker gamma exposure weakness. So I'll talk a little bit about this. At the same time that, yes, we should potentially prepare for some heavier shorting, some of the type of stuff that we've seen take place over the past couple weeks. So yesterday, after trading up, after the release of the Q3 earnings report, a lot flatter of a day. Volume way down below 9 million. Not quite as low as that uncertain period when we were really on this pretty steep bearish descent down out of this bullish regression channel we've been trading in for about the past 6 weeks. Pretty uneventful day early, right? We traded on these support lines, traded well within the bullish regression channel. Major reversals came after we established a pretty standard VWAP, standard deviation bracket here. Some reversal trades. We got a nice 1, 2, 3 off the top line, 1, 2, 3 off the bottom line, just about for about 80% of the trading day, basically up until around 3 p.m. and then even after 3 p.m. right? So maybe about the last 30 minutes, we kind of traded just out of this bracket for a bit. But still closed above $28, still closed above $28.50, which is where our 50-day moving average, 54-hour moving average is. So in general, a pretty sideways day. IV continued to dip off a bit, continued to peter out. We did get this pretty decent size bearish retracement, I should say, on a pretty substantial number of bearish options trades. So if you went and looked at our options flow data over on Unusual Whales, you'll certainly notice that we were heavily skewed in terms of bearish premium. So more than 4 million more premium spent on bearish sentimental options contracts. So that's going to mean contracts. It doesn't necessarily mean short or long contracts, right? It could be, so examples of a bearish trade, a short call is a bearish trade and a long put is a bearish trade, whereas the inverse is true in terms of calls and puts. So primarily what we were looking at was short calls, a lot of short call premium. Yeah, a lot of trades came in, really three big ones, really three big orders for April OPEX. Yeah, thousands of contracts. So we had this chained order here at $38, I think it was. Yeah, $38 calls. Somebody sold, I mean, it was a big chained up order. Somebody sold 4,755 $38 calls with an April expiry. So these are shorted. These were to open. Yeah, totaling nearly $3 million in premium credit. So this person received nearly a 3 million premium credit for this trade. The biggest trade on the day was actually this short call bet. Came in on the none side, which this tends to be trades that are instantly delta hedged. I haven't seen order flow, but somebody with order flow, you can go check this out. Whatever the delta is or was on this order at the time of purchase, likely an equal number of shares were purchased around the same time. So that would have been 10:30 a.m. So sometimes you'll see that'll happen. So that'll come in. Something like that happened like a month ago too. None side orders. So they come in as already delta hedged, which is very interesting. Somebody's simultaneously purchasing shares to delta hedge a short call position. So right, that's likely not a market maker. That's a bigger player, but not a market maker going ahead and opening a delta hedged short call strategy, short call trade. Market makers, of course, as we've talked about, take a much more dynamic approach. They do delta hedge, but they also heavily gamma hedge, which typically, to my knowledge, I mean, that sounds very difficult to do unless you have algorithmic trading or trading algorithms that are just running all the time that can do that for you. You'd have to be kind of clicking all day on your computer to kind of get that to work, given how gamma values change. So yeah, we're still looking at this scenario. Excuse me. We're still looking at this scenario where we still have these attempts by bears to try to push us out of this upward channel. Bulls obviously want us in this channel to move up higher into the higher range to sort of resume this upward trajectory like we've had. We do have this midline running through our, this collection, this 2 weeks of trade. So we're still on average staying above this support line, although our moving averages are kind of flattening out. Every time we moved out of this, I should say the past 2 times that we moved out of this channel, we had some sort of a bullish catalyst come in and push us back in. So we had on December 5th, we had that reaction to Roaring Kitty's tweet, his post on X. And of course, last week here we had this, or I should say this week, we had the bullish reaction to the earnings announcement and the lack of an at the market offering. So Ryan Cohen decided not to do an at the market offering. And the response to that looks to have been pretty bullish, right? Knocked us right back into this bullish regression channel. And so where we find ourselves is we find ourselves constantly sort of not committed to one or the other, right? Bears have largely been the ones that have had to, bears I say, right? The bearish channel has been the one that's required some more definitive redrawing in terms of how these catalysts have come in. They've brought us back into the bullish channel and kind of flattened out the way this has looked. If this goes on for another 5-10 days, it's going to look pretty range bound, right? It's going to move from a bearish regression channel into something range bound, like what we saw back here, pretty neutral. Really flat trading between a tight range without really any inclination as far as up or down. That might kill IV pretty hard, especially if we don't get a breakout to the upside. If we stay sub 30, say for another like 2 weeks, but above 28, which is a sizable possibility. Right, the longer it takes for us to kind of move down, the longer we don't move down out of this sort of 27, 28 up to 30 area, the more time the 204-hour moving average has to move up into an even higher position of support. So that seems to be the closest potential bearish target. If you were looking to try to send evidence or signals to the market, if you were looking for signals that sentiment was generally guiding us down, you would be looking for, you'd probably be looking at that as a target. But the more time passes and the higher that nearest signal on our predominating 4-hour chart goes, the longer it takes for it to develop without a kind of test of that level, the higher it gets. And I wrote about this in the article. In a couple of weeks, right? So probably sometime around Christmas. Christmas week is going to be a short week. We're going to have a half trading day in there, and Christmas itself is a day off. So we're going to have a short trading week sometime around there. So maybe toward the end of that week, maybe the beginning of the following week. So after December 27th OPEX. That's not an OPEX, options expiry. We might get a test of that level. It's certainly going to cross $28, and $28 is an important level for us on some broader time frames, in particular because $28 is where our 200-week moving average is. Okay, so our 200-week moving average is pretty important for GameStop from a historical perspective. So the last time that GameStop traded above its 200-week moving average, in fact, the last time that the 200-week moving average was consistently above all of our other moving averages to sort of recreate this position, was back in this 2020 lead up to the 2021 sneeze. So if we look back, right, briefly during this lead up, so in the early fall, around what would this be? This is September. So in October, we briefly traded up above the 200-week moving average and then shot back down underneath it to get back into this range. Then the lead up to December earnings, the stock moved up, it traded down, it found support atop the 200-week moving average, and then finished out the year on a little bit of a bull trend, continuation of the bull trend, for a total of 6 consecutive weeks trading above that moving average. Then we had 1 week, one red week, that was still above that moving average following New Year's. And then the next 3 weeks, of course, were this pretty insane parabolic activity on GameStop. Now, I'm not coming out here and saying, oh my gosh, moon, it's happening, whatnot. But I am saying that based on GameStop's particular history, based on, hey, if you're looking at historicals, if you're looking at how GameStop has performed around or as a result or in relation to these type of technical indicators, especially these long-term indicators, which, hey, Roaring Kitty in particular is someone who has pointed to these technical indicators as being important for his own technical analysis. That's a pretty bullish signal. We're at 3 weeks above this average as of right now, right? 1, 2, 3. If we close above $28 this week, which seems to be a very high possibility, I would say it's a very likely scenario that we see a close above $28. In part, that's because options max pain has moved up to $28 this week. So At $28, kind of on the nose, market makers are hypothetically at their optimal profitability point. So we'd be looking at mutually about 90% of both calls and puts expiring completely worthless at a close of $28, slightly below $28. Then it shifts a little bit in favor of puts. Slightly higher, it shifts in favor of calls. Now, those profitability numbers get really skewed the higher, like in close dollar increments above $28. So this is something to keep in mind. This is visible in our market maker gamma exposure. So as we can see, we have a lot of market maker gamma exposure. We have large call positions that are stacked up and accumulated right below $30 and above $28. So really, like, for every 50-cent increment above $28, there are thousands of options contracts that are going in the money corresponding, for example, at $29.50, our OI is something like, no, at $29, our OI is something like 9,000, or not 9,000, 6,000 something contracts. Okay, that's corresponding to 600,000 potential shares that market makers will need to be hedged by the end of the trading day, if indeed that $29 mark ends up in the money. Okay, and we basically opened today pretty close to that mark. Certainly, our pre-market trading had us trading around there. Now, so this gets really critically starts to endanger market maker profitability over 30. We currently have 20,000 contracts that are open at $30, and we have over 10,000 actually open at $32. So this range here, this range from $28 up to about 32, you can even throw in 33 there. There are a ton of calls here that presumably market makers are net short on. So really close to 30. I mean, obviously a close around 29 or 29.50, not great for market makers, not great for their profitability, but it's certainly survivable. They're still looking at about 80 to 85% of our open call contracts, probably about 80% expiring out of the money. But as soon as we get over 30, like, that percentage really shifts, and that does put a dent in their profitability. Part of the issue there too is because we have all of this call gamma concentrated, the right amount of bullish volume that comes in through the options market, if we get maybe something like a catalyst, there could be a really dynamic upward volatility event that would threaten to send a lot of these strikes into the money. So by hedging gamma, market makers are accounting for the rate of change in delta. Okay, the reason why this particular threat emerges on Fridays is because delta in out-of-the-money contracts is most sensitive to change based on the proximity of that option's expiry. So if you think about it, right, the probability, I've mentioned this before, the probability that an out-of-the-money options contract will expire out of the money goes up the closer you get to options expiry, given that the implied volatility says, okay, well, in this much time, the price could, hypothetically moves or has moved or looks to move about this much. But if you just have a few hours before that happens, the out of the money probability is pretty low. Just judging that, or is pretty high. The in the money probability is pretty low, based on how much time is left. Unless, of course, the IV is very, very high. I mean, GME in general has a pretty high IV threshold. It's generally a higher IV stock. But right, that occurs, right? And so as you have the probability of let's say like a $30 contract on a given week, let's say the 30s for this week, expiring out of the money, they will take a big hit to their delta. So the rate of change by which the options, delta is the measure by which an options contract value appreciates relative to a $1 change in the underlying. What's interesting about where we are in our price right now, and say relative to that $30 call position, is, as we'll look, I'm sure, the delta on our 30s is pretty low. Yeah, it's at 15 right now, 0.15. And it's, with us being at, say, around 28, 28.50, 28, something like that, right? It's pretty low. And that's going to mean that those changes are similarly pretty low. However, the gamma on those 30s is very high. The gamma on those is actually higher than the delta at around 16, 17. And basically what that means is, for these contracts will have their delta appreciate very quickly in the event of motion toward them going in the money. Because as they go in the money on the day of expiry, right, if we're only $1 away and all of a sudden we get this little bump and suddenly they're in the money, right, their delta has to appreciate really fast. And market makers will hedge shares very quickly in order to make sure that they are not exposed to those going out of the money, right? Because if those contracts are in the money, it goes particularly high, right? There's some catalyst that pushes those contracts in the money. They don't want to be buying shares to hedge those contracts that are more expensive than the strike price of the contract themselves, because that's how they lose a lot of money. So they hedge gamma values in order to account for that possibility. But of course, gamma values end up really high for near the money, just kind of barely out of the money contracts on Friday, particularly because of how much delta depreciation there has been based on I suppose just them running out of time, right? So the charm effect. So charm induced delta appreciation, time fed delta depreciation. Okay, this is a topic we can go into in more detail, perhaps on a weekend, right? I think I've mentioned I've gotten a number of requests to talk about how gamma squeezes work. I would definitely check out, if you want to. There's a great article. Actually, I'll link it in the description here. There's a great article about how the 2021 sneeze, that is that really that part where things got really exciting in 2021 was fed by these gamma dynamics put out by Spotgamma, which is where I've learned pretty much everything that I know about market maker gamma exposure. I'm absolutely by no means an expert. These guys definitely are. If you have a chance to check out their stuff, I'd recommend it. A lot of their trading tools can be pretty expensive, but their education is pretty top notch. I've never heard anybody else talk about the hedging dynamics and what influences market maker hedging quite like they have. So I would definitely recommend that. I'm going to link that in the comments as well. And then if I gather that there's this guy JN_KU, so Jin Ku, who had this following about a couple years ago, or some people actually had this following based on a lot of the things he had to say. He, like, beat by beat documented the 2021 sneeze when it was occurring, and talked a lot about how these various market maker hedging dynamics and the options market played into this. So if you go, I'll also link this, if you go to the GameStop library of DD, which is hosted by, I don't even know if they're still with the sub, but it is linked through the sub, Superstonk on Reddit. I will link the direct website to you so you can check it out. But go ahead and look at there is an archived collection of posts from Jinku back from 2021. So I think the fun volume is called something like the collected works of Jinku or something like that. He had his own Reddit channel for a while, Reddit subcommunity called Maximum Justifiable Risk, you want to go check that out too, you can do that if you're curious now before I have a chance to get a deeper dive into this topic. Okay, so anyway, we have a lot of this. We have a lot of this call gamma concentrated here that opens up some real risk for market makers with respect to their dealer profitability strategies. So their strategy or their optimal profitability as options dealers. So what makes sense to me, what sort of stood out to me is I noticed, some others noticed, I noticed a couple people posted about this on Superstonk. Some people, I think, in the comments to some of my posts pointed this out too. Yeah, we had some like weirdly overnight from 12:30 p.m. from 12:30 a.m. Eastern time until 3:30 in the morning Eastern time, the number of shares available to borrow for GameStop went down to 0. Okay, there's like Ultimator's been writing about this. There's some weird like settlement dynamics maybe that are going on overnight that have to do with when positions have to be officially settled. But the number of available shares never goes down to 0. So that was weird, number one. Number two, the number of shares available to borrow in general has increased quite substantially. It went up to, actually at 7 a.m., there were a total of 1.5 million shares available to borrow. And then someone went ahead and borrowed a good 800,000 of them at around 7:30 a.m., so just before 7:30 a.m. Eastern time, and then just kind of held on to them. If we actually look, since market's open now, did somebody go ahead and dump these off the open? Oh yeah, for sure. Okay, let me go over to our let me go over to Thinkorswim real quick. We can take a look at this. Yeah, so what I took a look at, what I basically outlined, actually in a few posts, I wanted to make sure I pointed this out even before I got the article out, because I think it's really important. Like I see that type of movement and I'm like, oh, somebody's getting ready for something. Let me point this out. You can see this now since we're live on trading on Thinkorswim. You can take a look here. Yeah, that's pretty cool, right? Yeah, just big dump off the open. So what are we looking at? Total shares. What's our opening candle? Not crazy volume. So they didn't just kind of empty. They didn't empty both barrels here, but it's a lot of volume. I wouldn't be surprised if they fed some of that with shorting. We're dipping down hard here off the open. Yeah. So basically, right in that situation where market makers have that type of gamma exposure, where it's like, I wrote about this. This is a critical moment. If somebody came in, if Roaring Kitty decided he was going to drop an X post today at maybe the bottom of that, of that gamma ramp around $28, or if we're at $29, or if we're approaching 30 and he drops that, like all of those contracts between $28, market maker max pain, and that all the way up to basically like $33, right? Those are tens of thousands of calls. Those are millions of shares and options obligations that would really seriously jeopardize market maker profitability. And hey, we don't know how deeply they're leveraged. Like, we don't know if this would end up in something like a market, a margin call for them or something like that. Like, I don't know. I don't have insight into their portfolios. And just for reference, right, when I say they, the most likely entity that I'm talking about here is Wolverine Trading, who is GameStop's designated market maker. They are the institution that has been given both the privilege and responsibility of making sure there's sufficient liquidity in the options market for you to go out and execute whatever trade that you want. So if you're going out and you're like, okay, like I'm going to sell whatever, 100 calls at the mid at this strike or something like this, and that stuff gets, that gets bought instantly. Okay, that's Wolverine acting as a designated market maker with brokerages to ensure to automatically buy basically whatever trade you put up. And then they find a way to position themselves advantageously with whatever you're doing. Since the majority of what traders go out and do, I also posted a paper that talked about retail trading in the S&P today, Beckmeyer et al. From 2003. 75% of retail trades in the S&P 500 on any given day, more than 75% are 0 DTE single leg options trades. So these are, on SPY, it's probably a good mix of puts and calls, but probably skewed toward calls most of the time. I wouldn't be surprised if you'd see similar numbers similar numbers for GameStop, although there isn't daily 0 DTE options. So, but I would say, 5 DTE, 4 DTE, whatever the weeklies are, that's the case. And the open interest numbers reflect that to a certain degree. So Wolverine Trading is the one who's facilitating these trades. Is basically they're net short. They're predominantly short at any call position. Put positions probably too. Although there's not generally that many puts recently that have been out on GME. Basically, not since April was that the case. Prior to April OPEX of this year. So when you're going out and you're placing an options bet, your counterparty is most likely Wolverine Trading, GameStop's designated market maker. So you're betting against that institution. Okay. Now here's the thing about Wolverine Trading, like a number of other institutions who are designated market makers, like Citadel, for example, who I believe used to be GameStop's designated market maker. I don't think they are anymore. Doesn't mean they don't trade GameStop, but Wolverine Trading also has an investment arm called Wolverine Asset Management. It's the same organization. One of the institutions has a responsibility to be a options market maker, and the other one actively invests in the market and trades in the market, not using market maker strategies. So Citadel does this too. So you can, they're different entities. They don't collude, definitely, but they're the same organization. They're run by some of the same people. They're run by many of the people with the same interests. Although, hey, I don't have smoking gun evidence of this. There's no reason why Wolverine Trading, the market making arm, can't be in contact with Wolverine Asset Management, the active investment arm, to have some sort of a relationship between them to kind of guarantee their mutual profitability, something like that. That's speculation on my part. Obviously, I don't have a smoking gun here, but something along the lines of that. So in any case, my mention of market makers here and market making strategies, if they can prevent something like this, if the market making arm ends up hyper exposed or overexposed, over gamma exposed, as they look to a certain extent to be right now, or at risk of being overexposed in terms of gamma exposure, a good way to potentially counter the possibility that a bullish institution or an unexpected catalyst like a Roaring Kitty tweet could potentially set off a pretty bullish response in the options market, could induce some heavy bullish options flows that could force this feedback loop between gamma hedging and gamma hedging pushing calls into the money, causing more gamma hedging, causing more euphoria and options buying, especially call buying that pushes more into the money. That could this feedback loop basically until we hit a more neutral gamma area, a more neutral gamma exposure area, which acts more as a hedging dead zone. That they would want to do things to prevent this from happening. They do not benefit from this. In fact, gamma squeeze. The only way that they benefit from this is that what they can do is they can jack up IV when this occurs, and this typically does jack up IV, in which case they profit from euphoria coming in and buying calls that are out of the money for later dates or for later expiries, or that are strikes way above where that gamma squeeze, that even if it's a few dollars, is going to run out. That's where then they can kind of offset their potential losses, but that's a big if, and they certainly don't want that to occur in such a rate like it did in 2021, where it was just it was just gamma squeeze after gamma squeeze after gamma squeeze, day to day to day, where basically there was so much options buying, it maxed out the options chain such that they couldn't offset their losses by opening the options chain back up. They needed to extend the options chain significantly, and back to back, I think it was like 3 days in a row, the options chain got completely maxed out. And there was no sign that it was going to stop until there was a collusion of brokers that came in and made it unavailable to continue to purchase GameStop. Okay, with that being said, there has been, there looks to be this type of gamma exposure risk on the part of market makers. And I would not be surprised, if they were taking some of these shares here, these now 1.5 million shares available to borrow, to target key technical and option support levels in intraday, to basically target this, try to keep things as close to their max pain point as possible, try and keep things as contained as possible to limit the degree to which a bullish institution, a major player, may try to exploit that weakness, exploit that gamma exposure concentration there. So that's basically what I was pointing out in the article today. Let's hop back over there in terms of my screen. Here it is. See this? Yeah, good. So I wouldn't be surprised to see some of that today. I think the most likely scenario is that, let's say there's no catalyst. Burn Kitty doesn't come drop a tweet, right? Ryan Cohen or some other major GameStop board, right? GameStop insiders don't release public information. Say, like Richard had this idea, Richard Newton. Now GameStop insiders can buy, especially maybe that was a big motivation for not doing the at the market offering. Maybe they if they're not announcing that they've bought in or that this has taken place, if Ryan Cohen, say, is not sinking more capital in, or whatever it could be, whatever the catalyst could be. If we don't get a catalyst, I would say advantage is definitely toward this sort of market maker favored scenario. I don't think we're looking at major price collapse, meaning, like deep penetration back into this neutral gamma area. I would say, if I had particularly strong bearish interests, I'd be like, wow, man, I would love it if somebody came in and like pushed this back in there for me, so I could, maybe try to get that 204-hour moving average touch and kind of extend how long, kind of say, okay, well, we had this 1 week kind of close below the 200 week moving average. But I think that's a bit of a long shot at this point, also given how much hedging support there is in this $28 to $30 area. I think without a catalyst, without a real kind of big information event, what we're probably looking at is, as we've seen I mentioned this in the article, but as we've seen to develop, trading in between these two larger but lower call gamma accumulation points, $28, $29, with kind of a max pain close. I think that's most likely. But there is this weakness, there is this potential ability where if we get the right amount of bullish options flow, that things could get kind of, volatile. So I'm not, right, don't take this as a, oh my gosh, go out there, go bet on something crazy like that. I mean, IV also kind of favors this, right? We're off these IV highs. It is possible that somebody does this. Somebody tries to exploit this weakness. But like I said, I'm not telling anybody, this is not an exhortation to go and make long call bets, to try to bet on this event possibly taking place. It could happen. It requires a certain number of conditions to be met. I think it would require a catalyst, or it would require some institution just being like, we've got the millions to just pump this thing. Let's go do it. Let's go push this. There's only this many shares available to borrow. Like, we got this. We measured this out. This will be profitable for us. These are low likelihood events, but there are institutions, as we've seen, if you've been along the ride for the open interest newsletter since August and September, and seen a lot of these kind of Friday little gamma ramps of $2 to $3 kind of pop off. I mean, it is an exciting thing. It's kind of a cool thing to behold when it does happen. But because they're low likelihood events, I have to say, please be careful with this type of thing. Certainly don't go run. I am not running to go bet on this necessarily. Long calls like this. I posted a number of things about this on Twitter today. These are structured. I always have this as a disclaimer in my posts. Long calls, the options market, it is structured, and these contracts are structured so that if you are the long party, if you are opposite the dealer, these things are structured to be against you. These are structured in favor of dealers. They are meant such that in aggregate, the dealers will win and be hugely profitable doing so, as we've seen is the case. So the odds are stacked against you. Now, with that in mind, right, this type of event could occur, but like I said, I'm not running necessarily to go bet the house on it, anything like that. So yeah, I am looking up right. Yeah, please go read this disclaimer, please. But yeah, I would say I'm really looking forward to seeing a potential close above 28 or even close to 28. Seeing continued trading above that 200-week moving average, another close, even if it's a red close, right? Another close above the 200-week moving average is a pretty cool thing to think about with respect to our potential for a requel. If this is indeed what Keith Gill is hinting about, what Roaring Kitty is hinting at, yeah, that's a cool thing to potentially see, potentially speculate about. Yeah. So I'm gonna go ahead and wrap up the breakdown there. I will certainly invite you guys to, yeah, as I said again, right after market close, come hang out. We'll spend an hour after market close, something like that, talking about reflecting back on the week, seeing what actually does unfold later today. So yeah, looking forward to seeing you guys there. It's going to be on YouTube, 4 p.m. Eastern time. Yeah, it's gonna be good. Let's go down just before we close. My friend Tom Moran here encouraged, one idea was to go ahead and look in the comments to see if, since this article is up, if people have had a chance to comment, to take some time to reflect on some questions. So let's see if we got any compliments. Compliments to you, Steady Turtle. Dankeschön. Hoogie. Cheers, Mojo. Yeah, you hang in there too, my friend. We've got Meliora, the better things. 200 MA keeps going. Shorted open, recovery. Yep, something like that. Yeah, you got the idea there, my friend. Captain Kroll also, yeah. Yeah, long dated call options are a good strategy if implied volatility is low. That's a good question, right? So before we wrap up, I'll mention that. Yeah, I mean, yes, right. So when implied volatility gets low on, relative to what IV numbers typically are in a particular stock. So like we saw in October, right? I did enter a sizable number of January calls in October when we hit year-to-date IV lows. Basically, that said to me that short option strategies were providing diminutive returns. To get meaningful returns, selling calls required that in order to meet, say, your weekly numbers from September, you needed to sell options that were dated for like December or January, right? You'd have to go 6 or 10 weeks out in order to get something approximating the weekly returns that you could have seen by just selling weeklies or 2-week bets back in something like September around earnings, right? So that sort of sent me a signal like, okay, like primarily, do I think, I think this requel thing is going to happen. I was also heavily betting on, for months I was looking out for that Cate catalyst and that that ended up paying off. So yeah, it only helped that IV was low there. So your risk is probably less if you're going for like in the money or at the money calls when IV is low. We're not seeing that same level of IV now. That's why I'm not necessarily being like, oh my gosh, look at how low IV is. But that's that's a good question. Yes, when you're going for, if you're trying to bet long, if you're trying to have an edge when it does come to long calls, you do want to look at low IV. And if you can find year-to-date low IV, but your outlook on the stock is still bullish, and you've been in a range-bound situation for a while, then that can be good. Hey, I'm not an expert on this. Again, that's just what I did back in October. But good, good question. Anyway, that's it for today's breakdown. Thanks so much, everybody. Thanks so much, everybody, for tuning in. Thanks so much for your questions. Thanks so much, Tom, for the suggestion about going and looking in the comments. Look forward to seeing everybody after today's market close at 4 p.m. for our live stream. So yeah, good luck out there, everybody. Let's go GameStop. Take care.